Bitcoin from Scratch, Understanding the Digital Revolution. Episode 1, Introduction to Bitcoin. Throughout history, the concept of money has evolved significantly. Initially, societies practiced bartering, exchanging goods and services directly. However, this methodology had limitations, such as the need for a coincidence of wants between the parties. For example, if a person wanted to exchange wheat for tools, they had to find someone who had tools and needed wheat, which was not always easy. To overcome these difficulties, the first forms of money were introduced, such as seashells, precious stones, metals, and eventually minted coins that allowed for a standardized and widely accepted value. These early forms of money facilitated trade and allowed societies to evolve into more complex and organized economies. Over time, money continued its transformation, giving way to paper currency. This represented a promise of value and was issued by central authorities, such as governments and banks. Trust in these institutions became fundamental to the functioning of the economy. Later, banking systems emerged, introducing new ways to manage money, allowing people to deposit their savings and conduct transactions more safely and efficiently. The evolution of money did not stop there, as digital technology revolutionized the way we understand money, leading to the development of digital money, electronic transfers, and payments through online platforms. This evolution culminated in the creation of cryptocurrencies, a form of digital money that uses cryptography to secure transactions and control the creation of new units, offering a decentralized alternative to traditional currencies. In this context, in 2008, a figure under the pseudonym Satoshi Nakamoto published a document titled Bitcoin, a peer-to-peer electronic cash system. This document, also known as the Bitcoin White Paper, detailed an electronic cash system that allowed direct online payments between parties without the need for a financial institution intermediary. This system was based on the idea of eliminating intermediaries and allowing anyone, anywhere in the world, to transfer value without relying on banks or government entities. In January 2009, Nakamoto launched the Bitcoin software and created the first cryptocurrency network, marking the beginning of a new era in digital finance. The first transaction, known as the Genesis block, contained a message referencing the 2008 financial crisis, reflecting the motivation behind the creation of Bitcoin, a response to the lack of trust in traditional financial systems. To date, the true identity of Satoshi Nakamoto remains unknown, adding an aura of mystery to the origin of Bitcoin and continuing to generate speculation and theories about who might be behind this innovation. Bitcoin introduced the concept of the blockchain, a technology that acts as a public ledger where all transactions are recorded immutably. The blockchain is decentralized and distributed across thousands of computers around the world, known as nodes, making it censorship-resistant and extremely secure. Each transaction is validated through a process called mining, in which complex mathematical problems are solved to add new blocks to the chain. Miners, who are the individuals or entities performing this process, are rewarded with bitcoins for their work, which incentivizes participation and ensures the functioning of the network. This innovative technology not only guarantees the transparency and security of transactions, but also eliminates the need to trust a central authority, such as banks or governments, changing the dynamics of economic and financial power. The blockchain also provides a reliable way to verify ownership and authenticity of digital assets. This feature has been key to the development of applications beyond monetary transactions. For example, smart contracts are possible thanks to blockchain, and they allow agreements to be executed automatically when certain conditions are met, eliminating intermediaries and reducing costs. These smart contracts have enormous potential to transform sectors such as real estate, logistics, and international trade. Additionally, blockchain is driving the creation of decentralized autonomous organizations, DAOs, which operate without a centralized hierarchy, making collective decisions through smart contracts. Since its inception, Bitcoin has sparked widespread debate about its role in the global economy. Its supporters see it as a response to the problems of the traditional financial system, such as inflation, currency devaluation, and monetary manipulation by governments. Being limited to 21 million coins, Bitcoin is seen by many as a store of value similar to gold, capable of protecting wealth against the devaluation of fiat currencies. This programmed scarcity is fundamental to its appeal as digital gold, as unlike fiat currencies, it cannot be created arbitrarily. Furthermore, Bitcoin's decentralized nature gives people greater control over their finances, allowing them to transfer value securely without relying on third parties. On the other hand, critics point to its volatility, the energy consumption of the network, and the use of Bitcoin in illicit activities, arguing that these limitations prevent Bitcoin from being a viable substitute for traditional currencies. One of Bitcoin's most controversial aspects is the mining process, which requires a huge amount of energy. Bitcoin mining involves the use of specialized computers that solve mathematical problems to validate transactions and secure the network. This process consumes large amounts of electricity, which has generated criticism about Bitcoin's environmental impact. However, cryptocurrency advocates point out that a significant portion of the energy used comes from renewable sources, and they argue that the pursuit of more energy-efficient solutions is driving innovation in the energy sector. Additionally, there are initiatives seeking to make the mining process more sustainable, using clean energy and developing new technologies to reduce energy consumption. Despite these criticisms, Bitcoin has evolved considerably since its launch. Over the years, it has gained increasing acceptance as a means of payment across a variety of businesses and platforms. Major companies such as Tesla and PayPal have begun to accept Bitcoin as a form of payment, which has bolstered its legitimacy. Additionally, it has been adopted as legal tender in countries like El Salvador, a development that has generated both praise and controversy. For El Salvador, adopting Bitcoin was seen as an opportunity to provide financial access to the unbanked population and reduce remittance costs, which represent a significant part of national income. However, critics argue that Bitcoin's volatility could pose a risk to the economy of a country that heavily depends on this cryptocurrency. What is indisputable is that Bitcoin has opened the door to a new financial paradigm where people have more control over their money and can participate in a truly global economy without barriers or borders. The decentralized nature and inherent security of blockchain technology offer an alternative to traditional financial systems, which have sometimes proven to be inefficient or unfair. Bitcoin has also fostered the development of a more inclusive financial culture, where anyone with internet access can be part of the network, regardless of location or socioeconomic status. This possibility of financial inclusion has led many to consider Bitcoin as a potential tool for reducing economic inequalities and empowering marginalized communities. The technology underlying Bitcoin blockchain has inspired the creation of thousands of other cryptocurrencies and projects based on this technology. Ethereum, for example, has expanded blockchain capabilities by enabling the creation of smart contracts, which are self-executing agreements with terms written directly into code. This has led to decentralized applications, dApps, that go beyond the financial realm, impacting sectors such as digital art through non-fungible tokens, NFTs, and revolutionizing the way contracts and legal agreements are made. NFTs have allowed digital artists to sell their works directly to buyers, eliminating the need for intermediaries and creating new income opportunities in the art world. The influence of Bitcoin and blockchain technology extends to fields such as decentralized finance, DeFi, where alternative financial systems are being developed without the need for traditional banks, allowing users to lend, borrow, and earn interest without the intermediation of financial institutions. The expansion of the blockchain ecosystem has led to the emergence of new forms of organization and governance, such as the aforementioned DAOs. These decentralized organizations operate on smart contracts and allow participants to make collective decisions transparently and democratically. This type of governance has the potential to change the way companies and communities function, promoting greater participation and reducing the influence of a central authority. Additionally, blockchain has begun to be implemented in sectors such as the supply chain, where its ability to provide traceability and transparency is helping to combat fraud and ensure the authenticity of products. This demonstrates that blockchain technology applications go far beyond cryptocurrencies, opening up a range of possibilities to improve processes across multiple industries. Objective: this episode aims to provide an overview of what Bitcoin is and its relevance in the current financial context. By understanding the evolution of money and the rise of cryptocurrencies, viewers will be able to appreciate how Bitcoin represents a significant innovation in the way transactions are conducted and value is stored in the digital age. Furthermore, this episode seeks to clarify key concepts and provide a solid foundation for those who wish to delve deeper into the world of cryptocurrencies and blockchain technology, understanding not only the potential of Bitcoin, but also the challenges and opportunities it presents for the future of the global economy. This episode also aims to provide a broad context on how blockchain technology is transforming different sectors and how its adoption may continue to evolve in the near future. Disclaimer: this content is educational in nature and does not constitute investment advice. It is important to research and understand the risks before making any investment in cryptocurrencies, as their value can fluctuate significantly. Cryptocurrencies are highly volatile and may not be suitable for all investors. It is always recommended to consult a financial advisor before making investment decisions.